Hi, everyone. Welcome to our webinar, How to Reach Your College Savings Goals with a 529 Plan. Thank you all for being here today. I'm Katie Flynn from savingforcollege.com, and joining me today is Matthew Toner, one of the advisors from savingforcollege.com and GradVisor. And we're also excited to have Julia MacMillan here from Upromise with us. Our webinar today is brought to you by Upromise. Upromise is a smart way to save for college every day by shopping online, going out to eat, booking travel, and more. It's free to join and simple to use, and you can learn more at upromise.com. During today's presentation, we'll be answering questions that were submitted with registration, and we'll also be taking live questions. So if there's something you'd like to ask during any part of the webinar, just enter it in the question box in your control panel. We'll do our best to try to respond to as many as we can during the hour. And if your question doesn't get answered, just visit our forum at forum.savingforcollege.com. After the webinar, we'll be sending out an email with a recording of the event and a link to download our Family Guide to College Savings, which is another great resource on 529 plans and college planning. There will also be an opportunity to give feedback on the webinar, so please let us know what you think. Okay, let's go ahead and get started. We all know college is expensive, so let's talk about the best way to save for your children and grandchildren so they can earn a college degree without excessive student loan debt. Every dollar you save today is one less they'll have to borrow in the future in student loans. Looking at the table, the 529 plan, the Coverdell Education Savings Account, and the Roth IRA all offer tax-free withdrawals when you use them to pay for college, but there are some important differences. One of the biggest advantages of saving with a 529 plan is that you can change the beneficiary without tax consequences to a qualifying family member. So let's say your child decides not to go to college, or you end up saving more than you need. With a 529 plan, you're able to change the beneficiary of the account to a sibling or niece or nephew who will be going to college. So we often get the question, why is a 529 plan better than maxing out a Roth IRA? Well, one reason you might choose a 529 over a Roth IRA is that anyone can open a 529. There are no income limits, so you can never be too rich or too poor for a 529. There are also no annual contribution limits for 529 plans. But with a Coverdell, you're limited to $2,000 per year per beneficiary, and with a Roth, you can only contribute $5,500 or $6,500 if you're over 50. 529 plans do have aggregate contribution limits that are determined by each state, and some can be as high as $500,000. There are also some differences when it comes to investment options. Your investment options in a 529 plan are going to be limited to what the program offers. 529s do not offer self-directed investments like a Roth, but 529 portfolios are managed by investment professionals whose objective is to maximize your college savings. And I believe Matt will touch on this more later in the presentation. Remember, in order to take advantage of education tax breaks, you have to spend the funds on what's considered qualified expenses. 529 plans offer a broad definition of qualified expenses. At eligible colleges, this includes tuition, fees, books, computers, room and board when the student is enrolled at least half-time, and that could be an off-campus apartment even. And you can now withdraw up to $10,000 tax-free to pay for tuition expenses at private, public, or religious elementary and high schools. Keep in mind that for K through 12, this is tuition only, unlike qualified college expenses that include more. And this is only $10,000 per year per beneficiary. Now, if you are saving for private elementary or high school, you also have the option of using a Coverdell Education Savings Account, but you are limited to the $2,000 limit per year per beneficiary. However, with your 529 plan, qualified K through 12 expenses only include tuition, but with a Coverdell, the qualified elementary and secondary expenses also include books, supplies, equipment, academic tutoring, and even in some cases, room and board, uniforms, and transportation. And of course, when we're looking at the UGMA accounts and other custodial accounts, the child can use the money on anything. This is a big difference between these type of accounts and 529 plans, where with a 529, the owner retains control over the life of the account. So that's, the owner could be a parent, grandparent, anyone. But with a custodial account, your child is going to gain control of the assets when he or she reaches legal age. So I'll take a few minutes to answer some questions we received already. Does the student need to attend an in-state college to use 529 funds? You can use a 529 savings plan to pay for any eligible institution, and that's going to include private, public, 2-year, 4-year, in-state or out-of-state colleges. Prepaid tuition plans do have more limitations, and I believe Matt will discuss those later. But if you want to find out if a particular school is eligible, which most are, you can always visit savingforcollege.com/eligible_institutions, or you can look in our tools section where we have a great tool. You just type in the name of the school and it's going to tell you whether or not your 529 plan funds will be eligible. People also often ask, are there any situations where room and board is a qualified expense? Room and board is considered a qualified 529 expense as long as the student is enrolled at least half-time. And as I mentioned, this includes both on and off-campus housing. So if your child is living in an apartment off-campus, the qualified room and board cost just has to be less than or equal to what's included in your school's cost of attendance allowance for room and board. And you can find out this information from your college's financial aid office. Someone also wanted to know if 529 funds can be used for college entrance exams or other preparatory activities. Unfortunately, only tuition, fees, books, supplies, and equipment that are related to enrollment or attendance at an eligible institution are considered qualified. So these fees that are paid prior to the student's acceptance for admission would be considered a non-qualified expense. And non-qualified withdrawals are going to be subject to income tax and a 10% penalty, but only on the earnings portion of the distribution.
Okay.
And then, yes.
We had a question come in here. Jordan wants to know, can you use 529 funds to attend a trade school?
Some trade schools, yes. Trade schools, culinary schools, beauty schools, they're all eligible schools like that, and other vocational schools. What you'd want to do, though, is check with the savingforcollege.com website and look at our eligibility tool where you can enter in the name of the school just to confirm that it is. But yes, many non-traditional post-secondary education institutions are eligible.
And Katie, real quick, it seems we're getting a few questions about it. Maybe if you can just touch on the K through 12 tuition and how it's affecting the states at the state level. I know we do have some information on savingforcollege.com about it.
Sure. So I would say the main difference right now between 529 benefits for college and 529 benefits for K through 12 tuition are going to be the state tax benefits, as you mentioned. So while all withdrawals up to $10,000 per year per beneficiary that are used to pay for K through 12 tuition expenses will qualify for the federal tax benefits, it's going to depend on what state you live in to see if you get a state tax benefit. So there's about 35 states that offer a state tax deduction or credit for 529 plan contributions, but not all of these states have conformed with the federal rules concerning K through 12 distributions. So what you want to do is check with your state's rules just to make sure whether or not you would qualify for that deduction if you are going to take a distribution for K through 12. And as you mentioned, Matt, there is a lot of information on savingforcollege.com where you can find our updated list of states that have adopted this new rule.
Okay, great.
So I have just one more question on my list, asking if a computer or a laptop is a qualified expense if it is used but not required, because it seems like the law has changed. And that is correct. The PATH Act in 2015 did make computers and related equipment a permanent qualified expense for college. So college students, you can use your 529 plans to pay for your laptop or your internet provider, things like that. And if there's no other questions in this section, I'm just going to hand it over to you, Matt.
Okay, great. Okay, awesome. So I'm going to go ahead and take a look at 529 plan basics. We'll go over what they are at a high level view, how they work, what kinds there are, stuff like that. So the first question is obviously, what is a 529 plan? And essentially what these are is that the government created these investment vehicles to help families set aside money for future costs. It used to be just future college and higher education expenses, but as Katie just went over, also for K through 12 tuition now. The way that they work is that post-tax dollars go in, the earnings in the account grow tax deferred, and then they are eventually tax free when used to pay for qualified higher education expenses that Katie just went over and K through 12 tuition. So I know Greg had asked before the webinar, are there any advantages to using a 529 plan over simply investing in the stock market? Well, this is one of the huge advantages, is that you're removing capital gains from the equation. So as I said, all the gains in the account are going to be completely tax-free when used for those qualified expenses. So every single state, except for the state of Wyoming, has at least one 529 plan. So there's 90 of them, over 90 of them across the United States. And you are able to invest in any one of them as an investor. So you can live in the state of Texas, then open up a California 529 plan, and your child can go to school in New York. That all works fine and dandy. And I'll go into a little bit later the kind of thought process when selecting a 529 plan in a little bit. Most of the time, the state will partner with some sort of financial institution to run that 529 plan. So you can see at the bottom here, some of the well-known plan managers are Fidelity, Vanguard, T. Rowe Price, BlackRock, etc. So they are actually going to be the ones choosing your investment options, setting the fees on these investment options, and actually holding your funds when you invest into a 529 plan. So let's go over some of the benefits. I know Katie touched on some of them, but we can go ahead and dig a little bit deeper here. So the first one is obviously going to be tax benefits. So I spoke a little bit earlier about the federal tax benefits, removing capital gains from the equation. But as Katie touched on as well, over 30 states offer some sort of tax deduction or credit on contributions into 529 plans. So there's also these incredibly powerful state tax benefits as well. Next is going to be crowdfunding. So unlike a 401k, where it's just pretty much you and your employer, if they're giving you a match, contributing to a 401k, anyone and everyone can contribute to this account. So it's a great way to increase your savings by having friends and family contribute directly to your 529 plan. And there's also some great powerful tools, including Upromise, that we'll talk about a little bit later, that can help increase your savings as well. So it's a really good time right now to be attending this webinar because the holidays are right around the corner, and that's a really great time to have friends and family and tell them, hey, instead of a traditional Christmas gift this year or a Hanukkah gift, we really appreciate it if you can contribute to our child's 529 plan. Many of the 529 plans have online gifting portals to make it super easy for friends and family to do so. Next is flexibility. I know we had already had a bunch of questions come in about this, so I'll try to cover as much as I can here. So 529 plans are actually a pretty versatile product. You can change your 529 plan at once every rolling 12 months and change your investment option twice a calendar year. So don't think, oh my God, I'm going to go ahead and open this 529 plan and then it's not going to go well, and then I'm completely stuck. So you do have the option of switching 529 plans and the investment option that you are allocating your money to. I get a lot of questions about what if my kid doesn't go to school or if they get a scholarship, etc. So first, regarding scholarships, you are able to remove the amount of the scholarship from the 529 plan without incurring any kind of penalty. So your child gets $50,000 scholarship, you can remove up to $50,000 from your 529 plan penalty-free. You can also, if your child doesn't go to school, there's a few options that you have. The first would just be leave the money in there. There's no kind of time limit to using a 529 plan. So your potential grandchildren down the road, maybe yourself, you want to use that money to go back to school or trade school, eventually culinary school, et cetera, as Katie said. So you're able to use that money. And you can do that by renaming the beneficiary. So say you have two children, the oldest child doesn't go to school, you can go ahead and just transfer that 529 plan into the younger beneficiary's name. You can name yourself the beneficiary, cousins. It's a very, very wide net. There's, I believe, an article on savingforcollege.com about qualified family members that you can transfer over your 529 plan to without any kind of penalties. Elaine had asked, Oh, go ahead.
Yeah, we just had a question come in sort of related to that, but what M is asking is, can I open multiple 529 plans for the same child? So for example, she wants to know, can she have one 529 plan at a brokerage where she has an account and then also a state-sponsored plan where she lives?
Yes, that's Eric actually had that same question too before the webinar started. Absolutely. So you can have multiple 529 accounts, one for the same child. So if for some reason, maybe you're between two different 529 plans, or as you said, you have a broker and you want to open one up yourself, you're more than welcome to do so. Also, I encourage everybody, if you have multiple children, you should have multiple 529 plans. So I always like to tell people, if you have 3 children, open up 3 different 529 plans, because it's going to affect a few different things. Obviously, how much you should be saving every month, the type of investment portfolio that you're in, and then eventually when you actually use that money, you can only use it toward the named beneficiary at the time, so it just makes it a lot easier, because eventually you're either going to have to open multiple 529 plans or keep changing the beneficiary on that account to use so. So definitely allowed to have multiple 529 accounts per beneficiary and for the account owner as well.
And now, I don't think we covered this, but it's a really good question from Pam. If you start a 529 plan in a certain state, do you have to use it in that state?
I think I probably glossed over it a little bit earlier, but no, absolutely not. So we'll even get into the prepaid plans in a little bit and how that works. But as I said, you can be a Texas resident, open up a California 529 plan, and then use that money to go to a school in Michigan or New York or Florida. So that's not something that you're going to really have to worry about. We had a question from Eric. For multiple kids with separate 529 accounts, is it possible to use funds from a sibling's 529 account? Well, as I said, you should have multiple 529 accounts for multiple children, but you don't have to just completely utilize that one account for that one child. So let's say you had an extra $10,000 in the eldest child's 529 plan, you could just go ahead and roll over a portion of those assets to one of your other child's 529 accounts without any kind of tax implication. So that's completely fine to do as well. Katie, any more questions on flexibility before we keep going? Okay, great.
Actually, Dana is asking for clarification on a point you made about scholarships. You can remove the scholarship amount from the 529 plan without penalties.
Yeah, so that's exactly right. So any gains in the account are still going to be subject to income taxes. But when you remove, so say you have a child, they don't go to school, you have no reason to name another beneficiary, and you just want to remove the money from the account for your own purposes. That's going to be known as a non-qualified withdrawal. And then just the gains in the account, never the principal, are going to be subject to normal income taxes and a 10% penalty on that. So if you contributed $5,000 total, your account is now worth $9,000. $4,000 of that is going to be subject to income taxes and a 10% penalty. However, when it comes to a scholarship, the 10% penalty is removed from that equation. So it's no longer considered a quote unquote non-qualified withdrawal. You'll still owe some sort of income taxes on it, but you're not going to be owed that 10% penalty
anymore. Okay, and one more question that I think is a good one from Mark. Can you have more than one beneficiary per 529 account?
You cannot have more than one beneficiary per 529 account. So that is why I always encourage, if you're going to save for multiple beneficiaries, open up separate 529 accounts. Okay, well, moving along here, I think this is something Katie already mentioned, but one of the great things about 529 plans is that there's no income restrictions. So it doesn't matter how little or how much you make, anyone and everyone can take advantage of these potent benefits of a 529 plan. Next, I'm sure we're going to get a ton of questions about this, Katie. We always do. I won't touch on it too much, but 529 plans actually have very minimal financial aid impact, so very good when it comes to applying for that FAFSA. So the assets in the 529 account are assessed at a maximum of 5.64%, meaning that if you have $10,000 in your account, your need-based eligibility will be reduced by a maximum of $564. And this is something Katie is going to go over in much more detail. We have an entire section on it. So we'll be sure to answer some questions about that there. And lastly, high contribution limits. If you are in the position where you can save a lot of money, maybe you will also want to be saving for your child to get some sort of graduate degree. In most cases, you can contribute over $400,000 to a 529 plan. So you're completely covered if you want to save for more than just your undergraduate institution. So we had before the webinar started, Prakash asked, is there a limit to the amount we can deposit when we contribute to a 529 plan? Does it matter if we make lump sum or monthly contributions? Well, the only limit to a 529 plan, quote unquote, is the contribution limit, the ones that are in excess of $400,000. However, to avoid any kind of tax consequences, the most you can contribute a year is the annual gift tax exclusion. So that's going to be for single filers, $15,000 a year currently, and for joint filers, $30,000 a year. However, 529 plans allow you to do something interesting, which is they allow you to superfund, which means that you can choose to do 5 years worth of gifts right up front. So that means that at any point in time, a single filer can put in $75,000 into a 529 plan, and joint filers $150,000 into a 529 plan. Any amount above these would reduce your lifetime gift tax exemption, which I believe, Katie, is up to around $11.2 million now. So any amount in excess of that will just start to reduce that number when it comes to estate taxes down the line. So Jeannie asked before the webinar, what age is best to start saving for your child's education? And my response is always the same thing. The best thing you can do is just to get started. I mean, the earlier the better, obviously, no matter what. Compound interest is your friend. You can increase, decrease your contributions over time, but you always want to get started earlier. You can see here just the massive difference just even 6 or 12 years makes, whether you're contributing $50, $100, or $200 a month. The earlier you get started, the better. However, there's no really such thing as starting too late. So you may not have a lot of time to utilize compound interest, but there are certain types of products such as CD products or FDIC insured products that may give you 1%, 2%, 3% guaranteed return if you're getting started late. And then in addition, you may live in a state that allows you to get those state tax benefits. So even if you only have a year or two until college, you still want to be taking advantage of those. So if you are getting started later, still no harm in going to check out some of those different types of investment options, and then definitely utilizing state tax benefits if your state affords you those potent benefits.
And now, Matt, you mentioned FDIC insured products. We did get a question of whether or not 529 plans are FDIC insured.
Yeah, it's a great question. So, and it's a little bit of a misnomer, right? So 529 plans are themselves not FDIC insured. However, some 529 plans will have FDIC insured products. So something that you can check out on savingforcollege.com. You can compare plans that do offer a certain FDIC insured products. And those, once again, are going to be the type of products that may give you a guaranteed return, albeit usually lesser return than investing straight into the stock market like the usual investment option. However, you could get, let's say, a 1.5% guaranteed FDIC insured return, also certificates of deposits available, stuff like that. But so you're going to have to check within your 529 plan that you want to open if they're offering that type of investment option.
Okay, couple more good questions. We have one from Karen who is asking if it has to be the 529 plan owner who makes the contributions that qualify for a tax benefit.
That's not always the case, and that's once again going to be something that you can research on savingforcollege.com. It is on a state-by-state basis. So in some states, it's just the account owner. In some states, it is just the quote-unquote contributor to the account. So there are some states that you could very well open up a 529 account, contribute to it, and then grandma and grandpa, if they're still paying taxes, can contribute and also get a state tax deduction as well. So once again, something that you can research on savingforcollege.com. It's on a state-by-state basis.
Right, and that's a very good question for this time of year. If anyone's thinking about contributing to a child's account, you know, it could be a niece, nephew, grandchild, anything, you definitely want to check to see if you would qualify for any sort of tax deduction. And then Chris is asking, where can we find an accurate online calculator to find out if we're on track for our 529 savings?
Funny you should say that. You can always check savingforcollege.com. It's a bunch of great tools and calculators on the site that can help you project the future cost of college, help you set up a monthly savings goal. So I definitely suggest everyone go check out the tools and calculators section on savingforcollege.com.
Okay, great.
Okay.
Okay.
So, all right. So let me try to get through this here. I want to leave everybody enough time for the rest of the presentation, but we'll kind of go through my four-step process when evaluating 529 plans and how you should really be thinking and what you should be thinking about when you're selecting one, because it does get a little bit complicated, as you guys will see. So step one is going to be you gotta have to decide between a 529 prepaid plan and a 529 savings account. So this is kind of how the 529 world is divided. So in a prepaid plan, unfortunately, only about a dozen or so states offer these types of plans. And the pitch is to, quote unquote, lock in tomorrow's tuition at today's rates. That's not exactly true. It sounds great. However, you're always going to be paying a premium. So let's say the current cost of the credit at your college is $130. You may be paying $170 per credit in order to lock those kind of tuition rates in. But it is the more, quote unquote, guaranteed option, right? If your state does not offer a prepaid plan, you can always invest in the private tuition 529 plan, which is a prepaid plan that works in the same way and has about 300 of our nation's top schools underneath its umbrella. So Lisa asked before we got started here, how are prepaid savings valued if a student goes to a college out of state? And this is something that you always have to be thinking about if you do open a prepaid plan. So each one of them are different. Unfortunately, you may have to sift through what's known as a master contract to kind of determine how they do the transference. But however, many of them will pay out an amount equal to the weighted average tuition and contractually specified fees at your state's public institution, not to exceed the actual tuition and fees you incur. So what this essentially means is it's going to cause a little bit of uncertainty. So depending on the type of school your child goes to out of state, you may have paid too much and you're not getting your exact return on investment, or you may have way too little. And I'll go over what that means in a little bit. So the other type of 529 plan is going to be a 529 savings plan. And this is the type of 529 plan most people associate with the term. So essentially, as I said earlier, you put money in, that money is invested into the stock market, into different types of mutual funds, and your account goes up and down depending on how that investment does. But these savings plans are kind of broken down into two different types of savings plans. There's the direct sold 529 plans. And what that means is that you're able to open up this plan yourself. You don't need anybody's help. You can just go to a 529 plan website, enter in all your information, pick an investment option, and how much you want to contribute, and it's open. And then you also have advisor sold 529 plans. And in these type of plans, you're going to need the help of an actual financial advisor to open it. On average, they have higher fees, but much more investment options to choose from. So DeJohn asked before we got started, does it ever make sense to go with an advisor sold plan? In my opinion, if you're simply going to choose an age-based option like majority of parents do, and we'll get into what that means in a little bit, I would say it doesn't. However, if you are a savvy investor and you would like to build a certain type of portfolio, it could definitely make sense for you if you actually play the market on a normal basis. So if that's something that you're looking for, please check out Advisor Sold Plans. Once again, something that you can check out at savingforcollege.com. Then to get back to the savings versus prepaid, Allison was wondering what are the advantages to each one. And Katie, this, as you know, could be a whole separate webinar in itself, but here's a few things to consider. So the prepaid is obviously a safer, more quote-unquote guaranteed option, but first, it may not be very affordable for all families. So an actual contract for a prepaid plan may start off at $200 or $250 a month, depending on the age of your child. Whereas in the heavy majority of these 529 savings plans, you can get started for just $25 a month. Also, prepaid costs are going to be tied to your state's the tuition at your state's institution. So, for example, I live down in Florida. We have a great program here called Florida Prepaid, and it helps you pay for school at one of Florida's institutions, University of Florida, Florida State University. But Florida schools are, on average, especially for residents, very, very, very cheap. So if my child were to get into Harvard eventually, I'm going to have a huge gap left over if I just chose to save her in the Florida prepaid. So because Florida, I mean, Harvard's going to be costing me maybe $120,000 a year, whereas these Florida schools I was saving for were about $15,000 a year. So you're going to have that huge gap. And then even if you are saving enough, usually prepaid plans just cover the cost of tuition. So even if you were to go with a prepaid plan, you may still want to supplant that prepaid plan with a normal 529 savings plan, which is going to help you cover things like the room and board, books, fees, and things of that nature. So definitely a strategy that you can think about using the prepaid along with the savings. So step 2 is going to be checking your state's tax incentives. So as Katie and I mentioned earlier, over 30 states offer some sort of state tax deduction or credit for contributions into a 529 plan. You can see on the map here what states do offer some sort of deduction, and some of them are more potent than others. So Frederick wanted to know, is there any advantage to investing in the 529 plan offered in my home state? And the answer is there could definitely be. So it's not super simple when it comes to just 35 states offer a state tax deduction or credit. In most of the cases of these states, in order to get that tax deduction, you have to open up your state's plan to go ahead and receive that deduction. So if you live in Chicago, you're in the state of Illinois, but to get up to a $20,000 state tax deduction a year, you have to open up the Illinois 529 plan. Same goes for a state like New York, or Georgia. You're going to have to open up your state's plan and be a state resident in order to get that deduction. However, there are some states, these magical states called tax parity states, and these are going to be Arizona, Arkansas, Kansas, Minnesota, Missouri, Montana, and Pennsylvania. In these states, you can open up any 529 plan across the country and still get that state tax benefit. So if you're lucky enough to live in Pennsylvania or Arizona, you can go ahead and shop around for the best 529 plan for you. Maybe it's the New York plan or the California plan, contribute to it, and still get that state tax deduction. But once again, there's one more thing to consider. In some cases, the states kind of offset these tax deductions they're giving by charging higher fees in the 529 account. So in some cases, your state tax deduction could be wiped away by paying much higher fees. Some cases, 5 to 6 times higher fees as a low fee plan elsewhere. So something to consider when you are shopping around for a 529 plan. So please keep an eye on that. Next, a few more things to research and compare. The first is going to be the plan manager, and those are the ones I talked about at the beginning of my presentation, the Fidelities and the T. Rowe Prices and the BlackRocks of the world. You want to know if they've been around a while. You can check on savingforcollege.com if that manager's contract is up soon. So all of a sudden you could have brand new investment options and brand new fees. So that's something to consider as well. And then in some cases, if you don't have a state that has a state tax deduction and you want to shop around, some people say, all right, I already have a Fidelity 401k, so maybe I just want to have a Fidelity 529 plan as well. So it's all in one place. So that's something to consider as well. Next is a pretty obvious one, is going to be fees. People don't want to pay a lot if they don't have to. So when it comes to 529 plans, fees can vary very widely. One plan can have over 10 times the cost of another plan, so you definitely have to keep an eye out. And that's especially the case with a advisor sold versus direct sold 529 plan. You could be paying as low as 12 basis points in a direct sold plan and maybe paying 140 basis points in an advisor sold plan. So if you do open an advisor sold plan, keep an eye on it. Make sure you're getting that performance to offset those higher fees. Investment options. So does the plan have a wide range of investment options? Do they have the options like we mentioned earlier, Katie, with the FDIC insured or a CD, certificate of deposit? How risky should your portfolio be? Do they have something that suits your tolerance for risk, whether that be super low or super high? So always check out investment options. And then last is another pretty obvious one, is going to be performance. Better returns means more money in your pocket. So keep an eye on how that plan has performed over time in 1, 3, 5, 10-year time periods. If you have, if you need help sorting through all of this stuff, there's some really great tools. Once again, our comparison tool and our 5-cap ratings on savingforcollege.com. So feel free to go ahead and maybe compare your state's plan to 2 or 3 other plans you may be considering. And then the last thing you should really consider that you're going to have to make a choice of when opening your 529 plan is actually selecting an investment option. So there's all different types of investment options that we'll go over. Each one of these investment options will have a different type of fee. They will carry with it a different type of risk. And something you also need to keep in mind is your investment horizon. So what investment horizon means is how long is it going to be until I'm going to have to tap this 529 account to use it. So essentially, if your child is a newborn right now, you have at least 18 years in order to make up any kind of losses in the account over time. So if in year 4, maybe there's a market dip and you lose some money, you still have another 14 years to make that up. So you can be a lot riskier with your portfolio. However, if your child's a junior in high school, you don't want to go ahead and throw in $50,000 in a super high risk, high reward type of investment option, because if there's a market correction, you could lose 20% of that by the time your child goes to college. So always be aware of how long it's going to be before you're going to be using it for college or also K through 12, as we mentioned earlier. So to go through the different types of investment options, the first one is going to be static. And what that essentially means is that these portfolios are going to have a very specific investment objective, and their asset allocation will not change over time, meaning that if you choose a portfolio, a static portfolio that has 75% equities and 25% bonds, it is going to have 75% equities and 25% bonds no matter how long you hold it. In this, going down this path, Danae had asked before the webinar, are there 529 plans with mutual funds as investment options, or is it all index funds? And plans will usually have both. There's passive index funds, actively managed funds, socially responsible investing funds. And as I mentioned earlier, if that's something you're looking for, a whole plethora of portfolios, you may want to take a look at some of those advisor plans that I mentioned. The next type of investment option is age-based. So age-based investment options automatically become more conservative as your child gets closer to college. So what that means is that when your child's a newborn, you may be 100% invested in equities. And then by the time your child goes to college, that same portfolio may only be 10% in equities and 90% in bonds to kind of watch out for those market dips that I talked about earlier. And this will happen automatically over time, little by little. So it's not like the static portfolios that are never going to change or automatically going to become more conservative over time. But something to look out for, many cases plans now have multiple quote-unquote tracks for these age-based investments, meaning that there is an aggressive track, moderate track, and a conservative track. So the aggressive track when the child's 18 could be still 40% in equities, and the conservative track could be 0% in equities. So once again, always keep in mind your risk tolerance and the type of investor you are. And then lastly are these FDIC insured types of investment options that we had mentioned earlier. These kind of more low-risk investments such as savings accounts or certificates of deposits, which are essentially going to guarantee you a rate of return over time. In some cases, it's the longer you leave the money in, the higher interest rate you're going to get. So maybe 3 years, you'll get a 2% return, or 1 year, you're going to get a 1% return. But these type of investment options are obviously great for super conservative investors, families whose children are about to go to college, people saving for the private K-12 tuition we mentioned earlier. So if that's something you're looking for, once again, head to savingforcollege.com and look for those 529 plans that are offering FDIC insured investment options. So Katie, I know that went a little bit long, so we might have some questions there, but it might be best to go ahead and wait for those questions towards the end, and if we can handle them, we'll go ahead and handle them. So with that being said, I'm going to go ahead and turn it back over to you.
Sounds good. Okay, so on to our next section, which we know we've already received quite a few questions related to 529 plans and financial aid. So, I mean, even after hearing all the good things that Matt has told you about 529 plans, some of you, I'm sure, are still a little bit hesitant to open one because you might be afraid that it's going to hurt your child's eligibility for financial aid. The short answer is yes, 529s do affect financial aid eligibility, but it's important to understand that the impact is going to depend on who owns the account and that the effect is usually very minimal. The amount of financial aid your child will receive is going to depend on your expected family contribution, or your EFC. And this is the amount that the college expects you to be able to pay out of pocket. So the higher your EFC, the less financial aid you're going to get. And the formula that they use to calculate EFC uses information that you've entered on the FAFSA. So this is going to include income and assets from both the parent and the student. And as you can see here, a student's income and assets are going to have the greatest impact on financial aid. Many people ask, if I open a 529 plan in my child's name, will it count as her asset? And actually, Greg asked a similar question at the beginning of the presentation. Well, here's the good news. 529 plans receive favorable treatment on the FAFSA. And that means the account, whether it's owned by the parent or a dependent student, is going to be considered a parent asset and receive the same treatment as a parent asset. And so that means the first $20,000 or so in a 529 plan is going to fall under what's called the asset protection allowance and will not be counted. The exact amount of that is going to depend on the parent's ages. Any amount above the allowance is only counted at a maximum of 5.64% of the 529 account value. So as Matt said, only $10,000 would only reduce financial aid by $564 at most. So this is quite an advantage compared to other student assets like an UGMA account where they're counted at 20%. Another advantage of a 529 plan owned by a parent or dependent student is that nothing has to be reported on the FAFSA when the funds are withdrawn to pay for college. So that's how parent-owned 529 plans work, but as we know, many grandparents, especially around the holidays, also use 529 plans to put away money for their grandchildren's education. And you probably heard that grandparent-owned 529s can hurt financial aid eligibility. This is true, and I'm going to explain how, and I'm also going to explain that we have a workaround so you can get around it. 529 plans make a great gift for a grandchild, but we get a lot of questions around it because it is a little confusing. So are these plans available for grandchildren? And if so, how does it affect financial aid? And then also, as grandparents, is it better for us or the child to own the account? Well, anyone can contribute to a child's existing 529 plan, but you can also open an account in your own name and then make the grandchild a beneficiary. Just want to mention, when we talk about grandparent-owned 529 plans, this really applies to anyone other than a parent. So this could be an aunt, an uncle, friends, or other relatives, anyone, but we'll just say grandparents, but it means it could be any of those people. There are a few benefits to having the 529 in the grandparent's name. First of all, the grandparent will retain control of the account, and that means they can take the money back if needed. So anytime along the way, if a grandparent, for whatever reason, either needs to or wants to take the money back, they can do that, and they can always withdraw from the account at any time for any reason. Just those non-qualified withdrawals will be subject to the 10% penalty and income tax on the earnings, as we mentioned. The second benefit to having a grandparent have their own account is that they might be able to claim a state tax deduction, as we mentioned. Of course, this depends on where they live, and some states will allow you to claim the deduction only if you're the owner. Some of them will allow anyone who contributes to claim the deduction. For example, New York's a state where you have to be the account owner or the account owner's spouse to claim a state tax deduction. So just make sure you check with your state's rules on savingforcollege.com to see if you qualified. And last of all, assets held in the grandparent-owned plan do not have to be reported on the FAFSA while they are in the account. But here's where it changes. So you want to be careful with a grandparent 529-owned 529 plan, because when those funds are withdrawn from the grandparent's 529 to pay for college and given to the student, the amount's going to be reported as student income on the FAFSA. And student income is assessed at up to 50%. So that means if a grandfather wanted to give $10,000 to help his granddaughter pay for college, it could reduce her financial aid eligibility by as much as $5,000. So that's pretty big. You want to avoid that. There's a couple ways to do this. First of all, you can wait until January 1st of your grandchild's sophomore year of college to pay the tuition. This only works if the grandchild is graduating in 4 years, since the FAFSA looks at income from 2 years prior. But by second semester of sophomore year, you should be in the clear to start taking the distributions and help pay for college. Another option is to roll over the money from a grandparent 529 to the parent's 529 just by taking 1 year's worth of tuition at a time. So if you wait until after the FAFSA is filed to transfer the 1 year's worth of funds to the grandparent from the grandparent 529 to the parent 529, it's not going to be reported as an asset on the FAFSA. You just have to be sure to spend the money to pay the tuition before the next year's FAFSA comes around. Also, if you use that strategy, just be sure to open the parent 529 in the same state as the grandparent 529, as some 529 plans do have recapture rules when you roll over funds to a different state's plan. So just to recap on the financial aid eligibility, withdrawals from a 529 plan owned by a parent or dependent student are going to have the least impact on financial aid eligibility. So if you have $10,000 in a 529 plan owned by a dependent student or their parent, it's going to reduce aid eligibility by only as much as $564. Now, if you have $10,000 in a 529 plan or custodial account owned by an independent student, that's going to reduce the aid eligibility by as much as $2,000. And then, of course, as we mentioned, a $10,000 distribution from a grandparent-owned 529 plan can reduce aid eligibility by as much as $5,000. So Matt, I don't know if we have any additional questions that I haven't covered on this topic, but if so, I can take those really quick right now.
Just about one or two, but once again, let's make sure we get through everything, and we'll go ahead and take some at the end if need be.
Okay, sounds good. With that, we'll move on to year-end planning. 2019 is almost here, so I can't believe end of the week is already December. So let's talk a little bit about how we can make some moves to get ready for 2019. If you don't have a 529 plan yet, the best thing you can do is open a plan right now, today. It doesn't take long. You can open one online, visit savingforcollege.com, as we mentioned, to learn more about what your state has to offer. And then you want to set up automatic deposits. With these automatic deposits, you won't have to think about your contributions, and it's going to make it easier to reach your goals. Now, I know Joanna did ask, do your monthly contributions always have to be the same? No, they don't, and you don't have to do automatic monthly contributions. So the best thing is just to open that plan, make an initial deposit, and then either set it up for automatic monthly or just deposit whenever you can. Whenever you get a little bit of extra money that you can put towards it, that's going to help. Every day you wait to start saving, you're going to miss out on the potential earnings growth from your 529. So the best thing to do is get started. Another thing you want to do right when you get started is join Upromise, but I'm going to let Julia talk about that in a few minutes. And then, of course, max out your state tax benefits. Most states, you have to make your contribution by December 31st to get that state tax deduction for 2018. But there are 6 states, Georgia, Iowa, Mississippi, Oklahoma, South Carolina, and Wisconsin, that have April contribution deadlines. So you have until sometime in April 2019 to make that contribution. So more information, you can find more information about that on savingforcollege.com as well. And as we mentioned, grandparents and other relatives may also be able to take advantage of a deduction for contributions made to parent-owned 529 plans. If you do have a plan, review your investment options and plan performance. You can make 2 investment changes per year if you're not happy with the way something is performing, or if you're not happy with your plan, you're allowed to make 1 rollover per 12-month period. And then remember, your contributions are also eligible for the annual gift tax exclusion, as Matt mentioned. So you could take advantage of these large gifts, $15,000 per beneficiary per gift giver in 2018. And then you also have the option to Superfund, where you can give up to 5 years worth of gifts at once. We did receive a few questions about withdrawals also. Contributing to the account is easy, but what happens when it's time to pay for college? After all those years of saving, you don't want to get stuck paying taxes or penalty on the earnings portion of your distributions. So how do you avoid the taxes and penalties? What you want to do is first add up all of your qualified education expenses for the year, and don't forget to include up to $10,000 in K through 12 tuition. Then you want to subtract any tax-free educational assistance, and also subtract any expenses used to generate the American Opportunity Tax Credit or the Lifetime Learning Credit, since there's no double dipping. You might also be wondering if your child gets a scholarship, or what if they attend a military school or trade school. We already touched on trade schools. Most of those are qualified 529 plan expenses, but a military school and a scholarship are treated the same way. If you end up with leftover funds because of one of these options, you can withdraw the amount of the tax-free scholarship without penalty, but the earnings portion of the distribution is going to be taxed as ordinary income. So you can avoid paying any taxes by changing the beneficiary, or just keep the money in the 529 account to use for graduate school or a future use. Military Academy, as I mentioned, is the same as the scholarship. So how to withdraw. Withdrawals, they need to match up with the qualified expenses that incur during the same year. And I think that someone asked about this. So right now, do not withdraw from your 529 plan in December to pay your spring tuition. That's an important one to keep in mind right now. And then Eric had asked, how are the funds typically paid out? We recommend making the distribution payable to the beneficiary. That way, if there are any non-qualified withdrawals, they'll be taxed at the beneficiary's presumably lower tax rate. And it will also, keeping it away from the school will help avoid any complications with the bursar's office. And then once again, just to reiterate, if the child doesn't go to college, you have a couple options. You can always change the beneficiary to a qualifying member who will attend college. You can save the money for graduate school or even further your own education. Or you can save the funds for a future grandchild. Or once again, you can withdraw, but then your non-qualified withdrawals will be subject to that 10% penalty and income tax, but only on the earnings portion of the distribution. And that about wraps up the savingforcollege.com portion of the presentation. And I'd like to hand it over right now to Julia MacMillan. Julia is Upromise's Senior Vice President of Business Development. She is responsible for revenue, marketing, and product management. And prior to Upromise, Julia was the Chief Marketing Officer at Foretel Solutions, a provider of SaaS platform solutions for real estate and infrastructure performance management. Previously, Julia also held roles at MBNA Bank of America, including SVP, Card Global Sales Executive, and Product Development Director for the Merrill Lynch Card Program. So with that, Julia, I'm going to hand it over to you to talk about Upromise.
Thank you, Kate. I appreciate that. Show my screen. There we go. So thank you everyone for joining the call. We appreciate your time. And I want to talk a little bit about saving for college and saving for college with Upromise. We know that saving for college, everybody wants the best for their kids, and college is part of that aspiration and part of that success and being the best that a child could be. However, we know that saving for college is also difficult. It's not easy. It conflicts with multiple saving priorities. However, at Upromise, we firmly believe that it's absolutely doable. The Upromise helps families save for college, and this is our sole commitment to you. We've been helping families save for college for almost 20 years. And with that, we offer the expert advice, simple savings tools, and unique saving offers that can help you save and accelerate your college savings every day. We know the college landscape is changing, and we want to be able to help you navigate through these changes. So with a Upromise account, there are multiple ways in which you can get incremental earnings to put into your 529 account and help accelerate those savings. So for instance, you can shop online through Upromise and earn college savings through hundreds of online retailers. You can also, when dining, link any credit card or debit card to your Upromise account and earn up to 5% of your total bill back in college savings. And additionally, if you're using a credit card, if you use the Upromise MasterCard, you can earn 1.25% cash back on every purchase. But with that, there's also additional savings accelerators with the Upromise MasterCard, whereby you have the option to round up to the nearest dollar for all of your purchases. So for instance, if you make a purchase of $79.14, you can round that up to $80 and get the incremental 84 cents put into your account. And you can use that option up to $500 a year. But even better, when you link your Upromise account and carry the MasterCard, and when you link it to an eligible 529 college savings plan, you'll receive an additional 15% on all of your cash back and rounds ups that are in your account. Upromise provides a lot of flexibility for you as well as for family members. And it's easy to join. It's free to join. And with your Upromise account, we link to any 529 checking and or savings account. So as you take advantage of college earnings and the opportunities, you can start to see your Upromise earnings grow. With Upromise, though, however, we do believe that the 529s are a great education savings vehicle. And all 529 college savings plans are eligible to be linked to your Upromise account. So, as I mentioned earlier, you don't necessarily need to have a 529 plan to join or to start using Upromise, and you can sign up and start accumulating college savings right away. And so if you want to get started as you're looking at plans and comparing those plans, you can still join Upromise and start getting those earnings right away by joining Upromise. And then once you've opened up your 529 account based on the one that you want, you can then link that account to your Upromise account. The way that it works is then once you achieve your threshold for transfer, and as Katie mentioned earlier with the 529, when you set it up, you want to do automatic deposits so that you don't have to think about it. What we do is once you hit your threshold, we automatically transfer on a monthly basis your college earnings that you've earned through Upromise into your linked 529 account or banking account. We are often asked, and many people have also asked here, well, what happens if I have multiple children? Well, just as we explained earlier, you can link your Upromise account to more than one 529 account. And so if you have 3 529s for your 3 children, you can link that your Upromise account and those earnings to those 3 529 accounts. And those earnings will then be distributed equally amongst those 3 529 accounts. We also talked about, and Katie mentioned grandparents. Upromise isn't just for parents. Anyone can be a member of Upromise. It could be grandparents, relatives, friends, and they can link their Upromise account to your 529 account as well. And so there's multiple ways to be able to grow those earnings on an incremental basis. We said earlier that, there was a slide that said you want to make sure that you save more, start early. And we firmly believe that a little bit of savings each month can add up over time. So it's the little things that you're doing every day that can help accelerate those college savings. So whether you're shopping, whether you're dining, whether you're having family and friends also link their Upromise accounts to your 529. Those will certainly help accelerate those savings. And if you think about that with some of the examples that were given earlier, a little bit can add up over time. And so by joining Upromise, you become a member of a community of like-minded individuals, like all of us are on the phone right now, who share one common goal. And that common goal is saving for college. And that's what we like to help do as you look and you're opening up your 529s. We want to help make sure that we're putting as much emphasis on saving and helping you do that and accelerate your savings the best way possible. We know that it's not easy, but we think that we can help. However, joining Upromise is easy, and we would like to help you with that. And so with that, I'm going to start to wrap up the presentation today and ask if there are, Katie or Matt, if there are any questions that we need to address before we do start to conclude today's presentation.
There's one question, Julia. I actually signed up for Upromise, and it was really easy to sign up. And like you said, I have multiple children that I signed up, and the whole process was super simple, just took a few minutes. But I did notice that there were some, Cyber Monday, Black Friday type promotions going on. So I just wanted to let everyone know, or if you can let everyone know, like that Upromise gives sort of like bonus deals during the holiday season, right? So people could take advantage of all the shopping.
Absolutely, and Katie, it's a great point, especially being the holiday season as it is right now. So with that, there are special, unique opportunities. And as being a Upromise member, you can get additional bonuses as a result through shopping as that is going on. So, it is right now, if you think about the holidays, when we say, open a 529 before the end of the year, that was one of the pieces of advice. We would strongly encourage you to join Upromise right now as well, and take advantage of those shopping opportunities and take advantage of those opportunities to gain incremental savings that would go into your 529 account.
Yeah, there was some great deals. And then Jennifer had asked, when did this change? She said she tried to link to her 529 plan account before and she couldn't. So there was a recent change, right, with Upromise?
There was a recent change, and so we've listened to our members and we've heard and believe that firmly it's very important to save for college. And so we have opened Upromise to all 529 plans. And so if you are a current Upromise member and haven't linked the 529 plan, please go in and do so. You have the opportunity now to do that. You can see it through the drop-down menu in your profile page of your Upromise account.
Okay, great. Well, it's the time for the webinar is just about up. And so if there are no other questions, just wanted to let everyone know, thank you for joining us, and especially thank you, Julia, for giving us the information about Upromise. I think it's a great complement to what we offer at savingforcollege.com. Everyone is going to be receiving an email following the webinar with a recording of the presentation. And then, as I mentioned, there'll also be a link to our Family Guide to College Savings, which you can download for free. And then we also just want to ask if anyone has any feedback on the presentation, please give it. We'd love to hear from you. Once again, thank you everyone for joining us.
Thanks everyone.